Sam Bankman-Fried, the once celebrated crypto entrepreneur whose empire is now facing bankruptcy, said Wednesday at his first public appearance since he stepped down as CEO of FTX that he did not try to commit fraud on anyone. Bankman-Fried, appearing at the New York Times Dealbook Summit, insisted in an interview conducted by CNBC anchor Andrew Ross Sorkin over a video call that he was shocked by his firm's collapse. "I was excited about FTX a month ago, I was shocked by what happened," Bankman-Fried said, adding, "I substantially underestimated what the scale of the market crash could look like and the speed of it." The interview occurred as a growing number of regulators investigating him and his former company, and the fallout from the collapse of FTX is ongoing. The company's new CEO John Ray III, said in bankruptcy filings that in his 40-year career, he had never seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. Ray is expected to testify before the House Committee on Financial Services December 13. The broader industry consequences are also continuing to play out, with crypto firm BlockFi filing for bankruptcy last week. And on Wednesday, one of the world's largest crypto exchanges, Kraken, announced it was laying off 1,100 workers, nearly a third of its staff. Several other speakers at the event also nodded to the fallout. BlackRock CEO Larry Fink acknowledged his company had invested $24 million in FTX and predicted that many crypto companies would not be around for much longer. The 30-year-old Bankman-Fried was flying high in the months prior to his crypto exchange EOCO's abrupt implosion. FTX signed a licensing deal with a major U.S. sports arena and ran a star-studded Super Bowl ad last winter. And as the market became increasingly volatile, driving investors out of the market and forcing major industry players to shutter their operations, SBF took on the mantle of the Industrioco's White Knight, folding insolvent firms into his own sprawling empire. But the crypto king Oco's vast empire came tumbling down when crypto trade publication CoinDesk published an article raising concerns about the solvency of Bankman-Fried Oco's businesses on November 2. At the heart of the report was a leaked balance sheet from FTX's sister company, Alameda Research, which showed the firm Oco's financial backing consisted primarily of FTX's self-minted FTT token Oco, a digital asset that, like many cryptocurrencies, is prone to price fluctuations. Days after the CoinDesk report, FTX rival Binance announced it would sell its FTX holdings. That announcement set off a bank-run-style rush of withdrawals. Just over a week later, FTX filed for Chapter 11 bankruptcy after failing to raise emergency capital necessary to return user zco funds and keep operating. Bankman-Fried said Wednesday FTX had been a profitable growing business but added that he lacked the bandwidth to run two companies at once. "I did not have the attention for it, and I was nervous about a conflict of interest between the two," he said of FTX and Alameda. When you go back to 2019, FTX and Alameda were very connected in a number of ways, he told the Dealbook audience. FTX, which ran a leaner operation than many of its competitors, failed to employ an in-house accountant, nor were its books ever audited, during its 3 years in business. Bankman-Fried continued to insist that FTX's U.S. subsidiary was fully solvent and could be opened today. On the first day of the bankruptcy hearings, FTX's attorneys painted a picture of the gross mismanagement and lack of oversight under Bankman-Fried that precipitated the firm Oco's rapid unraveling. "You have witnessed probably one of the most abrupt and difficult collapses in the history of corporate America," an attorney for FTX attorney James Bromley said during the hearing. Bankman and his associates greenlight lavish expenditures, including $300 million toward real estate purchases in the Bahamas for FTX and Alameda employees, according to filings from FTX attorneys. Authorities in the U.S., including the Southern District of New York Oco's Cyber Crimes Unit, and the Securities and Exchange Commission, as well as regulators in the Bahamas, are now investigating the collapse. Even before FTX went under, the industry was facing a post-COVID downturn and a series of smaller company collapses during the spring and summer. In the wake of the collapse, Bitcoin was trading Wednesday afternoon at roughly $17,000, roughly a quarter of the token Oco's peak value last fall.